Welcome back to the Northwest London Property Show. We're with our hosts, Peter Martin, and guest Ellie and Harry. Peter, over to you.
Thank you, Morris. So, Harry, tell us a little bit about this. What's the business bounce back loan, please?
There are two types of business loans. The most recent one came in this week, which is called a bounce back loan. And that's generally for small businesses. What originally happened is the government introduced a coronavirus business loans called CBILS. But to get the loan, you had to go through a normal loan procedure, which is cash flows, future projections, history, like you would do with any other loan. And so what they found is, especially with small businesses, is that money wasn't getting out to punters quick enough. So from the 4th of May, they introduced what's called a bounce back loan, where you can get 25% of your 2019 turnover as an immediate loan, as long as it doesn't exceed £50,000. From what I'm hearing, those loans are paid out within about 48 hours. And to get them is a very simple 6 or 8 set of questions online that you answer, and the money comes out quickly. And that's the idea for small businesses. Again, there are some qualifying criteria. So you can't be what's called a business in distress. In other words, if you've got a negative balance sheet, for instance, they won't give it to you. But the word on the street is that loan is coming out really quickly and is being very useful for smaller businesses.
Wow. Well, it all sounds very encouraging. How are you finding that these things are working on a practical level? How is it all being administered?
So, look, I think a lot of the time the administration is claim now that they'll look at the detail later. So, for instance, on the job retention scheme, on the furlough, claims are being paid out within 6 days, which is what they said they would be. It's pretty much on a minimal check self-assessment type of basis. So they do check employee NI numbers and your company's UTR number, but the claim goes in, you get a payment 6 days later. As I said, on the bounce back loans, the application goes in, people are getting paid 48 hours later. And I'm also hearing that on the local authority grants, they're coming out really quickly. So I think what the government's focusing on is getting money out there, but in everything, they're putting a very clear disclaimer that they can retrospectively come back and check the detail of how those claims were derived and basically kick the tires on those.
Okay. So they would have had to, HMRC or whoever, to, from nowhere, build all these platforms and all these portals and all these mainframe and massive sort of operating systems.
Yeah.
How have they been coping? Have they been operating okay? Because after all, we don't have any call centers. Everyone's working remotely. How's it working?
It is working pretty well. I mean, if I look at the coronavirus job retention scheme, the furlough claims, it took them a month to build the system, but they tested it and they said on day one, if 450,000 people at a time logged onto the system wouldn't fall over. And to the best of my knowledge, the system has not fallen over.
Wow.
I think where they are struggling is call centers. So if you're calling in, most of the time you're leaving a message to get a call back, which is somewhere between 3 and 7 days later. So you're not getting to speak to somebody immediately. But I guess their main aim is to get cash out there, and they're doing that pretty timeously.
The financial implications to the economy must be just absolutely imaginable. Harry, where is all this money going to come from to fund all of this?
That's a very good question. I mean, in my personal view, I think it's going to come from 2 places. I think you and me and everybody else are going to pay extra tax between now and the next 20 years. And the second is there's an international monetary fund, which is there for these exact purposes, where companies are contributing on a regular basis into that. And at some point, everybody claims on it. And so hopefully some of the money is going to come from the IMF. But ultimately, the answer is going to be taxes. So they're either going to have to tighten their belts or put additional taxes or find some way of generating the money to pay for all these things that they've had to basically create out of thin air.
What general advice do you have for your clients at the moment?
The general advice I would have is to A, look at your next 3 months and see what you need. B, see what grants you're eligible for, because grants are not repayable. Grants are effectively gifts from the government, although they are taxable. But for instance, the furlough money, the local authority grants are money that you're never going to have to repay if you qualify for them. And then the last port of call would be loans, because you can get a bounce back loan for £50,000 with a term of 5 or 6 years, but it's going to be a noose around your neck for those next 5 or 6 years to be able to pay it back. Having said that, there are no early repayment penalties. So if you can pay it back quicker, then you should. But the idea is to get the stuff that's not going to burn you later on first. And then if you still need the loans, to go out and see if you qualify for those loans.
But I'm just interested, looking from an aspect outside of UK, of the way it's working on the finance, on the loans from the government. Of course, we're getting loans are coming in here from our government for those people who are out of work at the moment due to the coronavirus. These loans are freezing the accounts here. Does that mean that at the end of all this, and people are going back into work and have to build up their money again, they're all going to be, anything that they owe, or not owe, but was frozen, will it not just pick up, or will it be mounting up? And at the end of the day, you say, come on, you owe us all this money, you've got to pay it back. That's a question for you, Harry.
Look, that's exactly what's going to happen, is that businesses are going to have to pay back the money. And that's why when the original loans came out, the coronavirus loans, the banks were still doing quite a rigorous due diligence on companies, because they wanted to make sure that there was some way of them getting the money back, because the government was only backing 80% of those loans. The government are now backing 100% of these bounce back loans. Now look, they're only up to £50,000. But look, if you go bust in the future and you never pay it back, you never pay it back. The government are liable to the banks to pay those amounts back. But yes, that's why the loan should be the last port of call, because you are building up the huge liability that you're going to have to pay back over a period of time. And I mean, that's even true in what the guys were talking about earlier, which is on the mortgages, right? Your mortgage doesn't disappear. All you're doing is pushing your loan into the future. It's the same principle. So yes, my advice would always be to not take loans if you possibly can. But if it's life or death, sometimes you don't have a choice.
Thank you, Eddie. I wanted to so we hit upon the basics. What's happening to existing mortgage applications at the moment, which are open?
Good question. So it depends what stage they're at. So there are clients who would have applied for a mortgage prior to COVID happening, and some of those applications, if the surveyors were able to get out to the property in time before lockdown, those cases have proceeded to offer, and then essentially those are continuing to push on with the legals, and the solicitors should be able to carry on with those applications and push forward to exchange completion. There are other implications in respect of exchange completion, but the applications themselves, the offer still stands. The applications whereby they've been submitted whilst lockdown has been in place, there's been two approaches. One approach is that the banks are their business model is to lend money. So they have created what they call AVMs, automated valuations, or what they call desktop valuations. And where they have enough data from the Halifax Price Index, data from Zoopla, wherever else they get the data from the Royal Institute of Chartered Surveyors, if they are able to attribute a value to the specific property that they're looking to take security on, they will then value that property. And then off the back of that, they will then be able to push the case forward and provide a mortgage offer to the client. If they are unable to gather the information they need to obtain the valuation, that case literally will sit on hold. And as soon as we are out of lockdown and the banks and the Royal Institute of Chartered Surveyors have worked out ways to go and visit properties, that's when the valuations will continue to take place and the applications will push forward.
Okay, so through my experience, what would generally happen is that if someone's applying for a new mortgage, at such time as the bank would go to offer, the mortgage would be open for a fixed period of time. So generally 6 months, isn't it? So
Correct.
they'd offer, the mortgage is open for 6 months. If you don't complete on the transaction by the cut-off date, i.e. the end of 6 months, you've lost it. You have to go back to square one. Given the circumstances, has there been any deviation from that, from the banks?
So there's a few points, yes. So the first point is that the banks have said that if one has been furloughed or they've lost their job, they are responsible, they are entitled to basically inform the bank, and therefore the bank would have to reassess the case to see whether they're still eligible for that mortgage. If their jobs are stable, even if they've been furloughed, but their income is still the same, they're able to obtain that mortgage. But you get to the end of the mortgage offer period, there are lenders that have been able to offer extensions to the mortgage offers hopefully for another 3 months. Every lender works differently, but the banks are there to try and they want to continue to lend, so they are extending the offers where they can, and especially on new build properties as well. New build properties, they're definitely able to extend the offers for a longer period of time.
Are lenders accepting new mortgage applications at the moment, Ellie?
So yes and no. There are, I'd say the smaller lenders have been sort of only had their doors open for, let's say, the last 5 years, where a lot of them have actually closed their doors for the period of time, not fully shut, but just closed their doors for the time, mainly actually to support lots of the thousands of clients that are asking for payment holidays, and they simply don't have the staff to manage the payment holiday requests and also applications. So therefore they've said, we're closing our doors for applications because we're looking after those existing clients, which is the right thing to do. The banks that have got the infrastructure and the staff to look after both sides, they have kept their doors open, but they have restricted what they are able to offer. So for example, pre-COVID, banks could in theory offer mortgages up to 90, maybe even 95%. Most of the lenders nowadays have said that they're restricting applications up to circa 80% loan to value. So therefore, any cases where the loan to value is higher, they're saying you can't apply at this moment until we're out of this period of time.
Okay, so Bank of England base rates is now an incredible 0.1%. What do you think will happen with rates going forward? Do you think lenders will start to pass on these discounts to non-tracker products?
It's a great question. I have this conversation every day with clients. Unfortunately not. It's always been the case that whenever there's been a drop in the base rate, it never automatically gets passed on to the end client in terms of the fixed rates being offered. So whilst there has been a small reduction in a certain few rates, there's actually been an increase in some of the interest rates being offered as well. So therefore, the position that we're in now in terms of the fixed rates being offered by the banks, it's very similar to what we were at before the Bank of England reduced the rate by 0.6%. So there isn't much of a change in that respect, and I don't see them changing their approach at all because at the end of the day, they're there to make money.
What impact do you think COVID-19 will have on the lenders and the industry as a whole, Early?
So I think the lender's approach is going to be a lot more cautious, especially when it comes to things like income, and especially for individuals that run their own businesses. So for self-employed individuals, be it whether they're sole traders or whether they're directors of a limited company, I suspect they could impose, not sanctions, but they could impose positions whereby they say, well, rather than pre-COVID, well, we'll use all of your salary and dividends as the provable income for the mortgage, we might only be able to use 80% or 75%. They might take a reduction off the salary that they could normally work off, which protects them in terms of the future borrowing. So there could be that. They're learning on their feet every single day. So they'll take a much more cautious approach, but at the same time, they are there to lend money. The property market is a major part of the economy, and they want to lend wherever they can. And hopefully, we'll be able to continue to look after clients and help them get those mortgages they were able to get beforehand.
Thank you. And what is, in closing, what is your advice to your clients at the moment?
At the moment, first and foremost, enjoy your time with your family beyond everything else. This is an opportunity that no one really ever has. So this is a great time to make the most of that time and sort of the important things in life. But beyond that, when it comes to financial affairs and property and mortgages, just reconsider your position. Think about what how your financial position is at the moment, your employment, are you stable? Think about your savings and really just consider your future plans and know that any movements you make towards a property purchase, you need to make sure you've got the right level of savings in place and you're not going to be exposed to any undue risks that are going to have a negative impact on you in the future.
Thank you very much. And thank you very much to our guests, Ellie Kosiner from Harford Consulting and Harry Gasston from Complete Accounting Solutions. And back to you, Maurice.
Peter, thank you very much. I think we've discovered a new David Frost in our Peter there sitting in northwest London. I hope you enjoyed that, and I must say, very professional. I enjoyed all of you. Ellie, fascinating to listen to it from our side of the ocean, if you want to know it's the ocean. But it's great to hear you. Thanks, Ellie, and thanks, Harry, as Peter said. The Northwest London Property Show certainly shines a light on what's happening at the moment as we go through this coronavirus. Let's hope we get out of it soon. And remember, all the contact details for Ellie, for Harry, and of course, most important as well, for our host, Peter, will all follow this show, emails and telephone numbers. Thank you to each and every one of you. I enjoyed every second of it.